Hey everyone, welcome back to Corporate Decoder. Today LINC just filed a current report on their acquisition of the Melrose Park campus, and I am seeing a clear signal about their financing strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. Lincoln Educational Services is making a big move to own its facilities, and we're going to break down how they're paying for it and what it could mean. Alright, let's get into what Lincoln Educational Services Corporation is reporting. They've officially completed the acquisition of a property at 8315 to 8317 West North Avenue NU in Melrose Park, Illinois. This isn't a completely new location for them. They've actually been leasing this spot and operating their Melrose Park campus from it. Now, they're buying it outright. The price tag for this campus is $18.8 million. This is in line with what they agreed to back in May. Now, how did they fund this? They took out a mortgage for a significant portion of that cost. Lincoln Technical Institute, a subsidiary, secured a mortgage from Provident Bank for $15.04 million. That means they borrowed most of the money needed. The rest of the purchase price, just under $4 million, was paid for using cash they already had on hand. To get that loan, they signed several important documents. We're talking about a loan agreement, a promissory note, which is essentially an IOU, and a mortgage on the property itself. They also put up the property as security for the loan, which is standard practice for mortgages. Let's talk about the loan details, because this is where it gets interesting. The loan is for $15.04 million, and for the first 5 years, they've locked in a fixed interest rate of 5.99% per year. That is a pretty reasonable rate, especially in the current financial climate. But here is the catch. After those initial 5 years, the interest rate will change. It will become a variable rate, tied to the yield on 5-year US Treasury securities, plus an additional 1.75%. What this means is that their interest payments could go up or down depending on market conditions after the initial fixed period. They do have a floor though, the rate will not go below 5% per year. The entire loan needs to be paid back by the 1st of July 2036. That's a 10-year term. Starting the 1st of August 2026, they'll be making monthly payments of about $97,628. This payment covers both the principal amount borrowed and the interest. Over time, as they pay down the principal, more of that payment will go towards interest and less towards the principal. Now, this is a critical point to secure this loan. Lincoln Educational Services Corporation itself, along with its subsidiaries, has agreed to act as guarantors. This means if Lincoln Technical Institute can't make the payments on the loan for the Melrose Park campus, the parent company and its other subsidiaries are on the hook to pay Provident Bank. This is common when a subsidiary is borrowing, but it shows how the parent company is backing these significant investments. The fact that Lincoln is choosing to buy its facilities rather than lease them signals a long-term view. Owning property can provide more stability and control compared to leasing, where lease terms can change or properties might not be available in the future. It also aligns with their expansion plans, like opening a new campus in Maryland, as we've seen in recent headlines. They seem to be building a stronger physical footprint. Now, we're not seeing a ton of detailed financial tables directly in this particular 8K filing. This report is primarily about the completion of this acquisition and the related financing. The actual financial numbers for revenue, expenses, and profitability would be found in their regular quarterly or annual reports. However, the loan amount itself, $15.04 million, is a significant chunk of change. If we look at Lincoln Educational Services market cap, which is around $1.7 billion, this loan for a single campus represents about 0.9% of their total market value. It is a substantial investment for one location, but given they have multiple campuses, it makes sense as part of a broader strategy, looking at the broader context. Lincoln is performing well. Recent news shows their stock has been on the rise, partly due to being added to key Russell 2000 indexes. This acquisition of a physical asset like their campus fits with a strategy to solidify their business and potentially increase its tangible asset backing. Some analysts even suggest the stock might be undervalued. The risk I am watching is how this variable interest rate will impact their finances in the future if interest rates continue to climb. What I am actually looking for is to see how this increased ownership of assets translates to their balance sheet and their overall financial stability in the coming quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord.